I'm Jason Stipp from Morningstar. The European Central Bank took several measures to stimulate the Eurozone economy today. Here to offer his take on those measures is Morningstar's Bob Johnson, our Director of Economic Analysis. Thanks for joining me, Bob.
Great to be here today.
Before we talk about the measures that were announced by the ECB, let's talk about the general economic situation in the Eurozone and why these measures were perceived to be necessary.
Yes. I think a couple of weeks ago we got some news on GDP, which grew 0.2% between the fourth quarter and the first quarter, and you annualize that, that's 0.8%. And that was a little bit below expectations, and certainly the U.S. is growing faster, China is growing faster. I mean, it's one of the lowest growth rates out there. So certainly that was a concern. And there was some fear that had slowed even some more recently. And the PMI, the Purchasing Manager surveys for Europe, had dropped from kind of 54, 55 in January back to the 52 level most recently. So that's a little bit more forward-looking. So that kind of means, gee, things are going to be a little bit slower even. And then you've got the third thing that came out just 2 days ago, which was European inflation, which came in at 0.5% year over year versus 0.7 the previous month. So, and that 0.5%, I mean, that's not quarter to quarter or month to month. That's like May of last year compared to May of this year. We were only up 0.5% for Europe, and the target is 2%.
And what does that mean? Why is that so dangerous to have inflation so low?
Well, because then you start to build deflationary expectations and people hold off buying thinking, well, it's going to be cheaper tomorrow. And it's harder to get rid of. You have to do all these games that, frankly, they started to do already, the negative deposit rates and all the really oddball stuff. And they really would like to avoid that. It's a lot easier to control monetary policy and economic growth when you've got at least a modest bit of inflation. But when you're in deflation, it's hard to fight your way out.
So let's talk about some of those measures that they implemented given that backdrop. The first was cutting a key interest rate to 0.15% from 0.25. So 0.25 is already pretty low, but they've moved it even lower.
Yeah, that's their main lending rate, the main one that they use to present their rates. And I'm surprised they hadn't brought that rate down sooner. I mean, it's frankly a little bit lower in the U.S. than what it was. Now this brings us a little bit more in line. So that was good to see, and the emergency rate also came down probably a little bit more drastically from 0.7 to 0.45. So that came down, and then the third component is that the banks are paid money when they put it in the central bank usually, and in this case the reserves they're going to charge them a fee. They're actually going to make it a negative interest rate of 0.1%. And so the purpose there is to hope that banks will lend the money out rather than having a little bit of it confiscated every year.
Do you think that's going to work?
I think it could work, although you got to keep in mind that we're telling the banks to be more cautious with the new Basel III regulations and saying, well, we don't want a repeat of all the old stuff, and yet. By doing this, you're certainly going to encourage them to take some riskier loans.
So you want them to loosen the purse strings a little bit, but not too much.
Hopefully not too much.
Okay, you mentioned that you were surprised some of these rates didn't move sooner, some of these actions didn't come out sooner. Why didn't they? Why have they've been talking about that they're ready to take action? They finally did take some action. Why did it take so long?
Well, I think they haven't probably got a lot of ammo left. At least I didn't think they did, and I think that. They wanted to just talk about it rather than actually implement it and hope it had the same effect. And I think now they've had to put their money where their mouth is. And I think they've really had to do that for some time. And then you've had I think the Germans have objected sometimes to some of the measures. They really wanted not to take as strong an action as maybe the ECB and some of the other countries wanted to take. And so that's another thing that's held things back. But I think this really, really low inflation rate probably really forced the Germans' hands.
One thing that they still have in the toolbox that they haven't deployed yet is quantitative easing.
Yeah.
To what extent do you think that might be necessary in combination with these other measures to get the effects that they want to see on the inflation rate?
Well, I think the strongest statement he made, remember last year about this time, is we'll do whatever it takes. This year, we're not through yet is the motto that came out of the press conference that everybody will latch onto. And so I think there's some thought that maybe some of the quantitative easing, which is buying long-term bonds directly, which they've been pretty much opposed to for some time, and they're laying the groundwork to do that. They haven't actually done it. And the other thing they've done shorter term to improve lending is that they've now got another program where if the banks put up collateral, they'll lend them more money so they can make more loans. And so certainly the issue is in Europe, banks are much more important to the overall system than they are here in the U.S., as important as they are here. here at least we've got a bond market you can go to. You've got a stock market you can go to. You've got an asset-backed security market that's huge. They've got one in Europe. It's a fifth the size of the U.S. Market. So you just don't have a lot of alternatives other than the banks. So certainly to stimulate the banks is important. And certainly this program that today will encourage the banks to lend more money. It's $400 billion. It's not a small program. They've tried it before, and it has helped the economy. And I think the thought is that they hope it does so again. And if that doesn't work, then we roll out the big guns, the QE, which is really, I think, probably the thing that got people most excited.
Okay, so these are the measures that they're taking in Europe now or may take in the future if they need to. But what is the impact potentially then for the rest of the global economies?
Well, I think that's a great question. As you look at the total world economy, certainly by bringing rates down, they join a large crowd already. With China, Japan, and the U.S. all already doing extensive measures. So they're kind of late to join the party. Certainly one of the things it will do is bring down the euro exchange rate, and certainly that would be good news for their exporters. So that's certainly good news. Probably less good news for U.S. exporters who now will have to compete against a tougher European competitor. So that's certainly one thing that's out there. Certainly it's a world bond market in a way, and certainly the U.S. rates have been down over the last 6 months. The 10-year's been down from 3 to about 2.5%. Mainly because European bonds had fallen, the rates had fallen so much because of anticipation of today's meeting. Today's meeting was not a surprise. We knew it was a June meeting and that it was coming. And certainly the markets had largely anticipated. Spanish debt at one point was at something like 2.8%, which wasn't very far off what the U.S. Treasury bond rate was. So certainly some of that was anticipated in there, and it brought U.S. rates down. And I think we may not actually see the rates move that much from here.
Bob, some great insights on the ECB's actions and the potential knock-on effects. Thanks for joining me today.
Thank you.
For Morningstar, I'm Jason Stipp. Thanks for watching.